I remember, I was doing a sort of a different kind of analysis, and I realized it's like, huh, I'm only when we started Ramp, I was 33% of the headcount. I'm 10% now, and I'm soon going to be five, and I'm soon to be one today. I'm about half a percent.
It really informs kind of how I think about investing today, which is biased primarily towards fintech companies that lead with software, what I would call like a network, as opposed to leading with a financial product.
So product strategy, I think what we learned at Lending Club was really the impact of recurring revenue.
Hello, everyone, and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the US, Canada, and Latin America. In this special episode, we explore valuable company-building lessons and mistakes shared by 20 of our guests from over the last 2 years. So if you're building a business, I hope you find it helpful. And I invite you to leave a review on Apple Podcasts, Spotify, or whatever you get your show so more builders can find it. This show is divided into 4 categories of insights: organizational culture, product strategy, leadership tactics, and sales and marketing. Each chapter explores critical aspects of building a tech company, featuring the CEOs and founders of companies like Ramp, SoFi, Gusto, Lending Club, Figure, Upgrade, Melio, and Carta, amongst others. I think this episode is a treasure trove of lessons learned and strategic advice for current and aspiring fintech builders. I'm also including the links to each individual episode on Substack so you can dive into each one of them. First up, Mike Cagney, CEO of Figure, and Matan Bar, CEO of Melio, stress the importance of a strong foundation and mindful hiring to shape a company's culture. Josh Reeves, CEO of Gusto, and Prajit Nanu, CEO of Neum, highlight the dangers of poor hiring practices, emphasizing the need for value alignment. And Itai Damti, CEO of Unit, discusses the value of learning from mistakes and adopting a flexible approach to minimize future risks.
One of the biggest things was when we started SoFi, we really had no idea what it was going to become or how big the opportunity was. And, we were obviously super fortunate and lucky that there was a significant opportunity there that we could build into. But it didn't give us the opportunity to lay a foundation for culture and organization structure that, would support that kind of growth and that kind of market opportunity. And, as a consequence of that, we didn't have a super instilled culture, which was a significant headwind in terms of growing the organization, because we had, in particular, a lot of conflict within the organization and a lot of situations where, people weren't all oriented to the same objective or same goal and infighting and so forth. And, ultimately that was all my responsibility. And something that I took very seriously as I was thinking about Figure. And one of the things that we did with Figure is the founding team spent a couple of months before we even went to raise capital for it, just establishing what the rules of the road were going to be. So what is the culture that we were going to try to build? What were our expectations of each other and expectations of everyone that we brought on board? What would we tolerate? What would we not tolerate? And just, established a very clear understanding of a rubric that that was genuine, right? That we believed in, and could execute to. And in particular, one of the biggest things that we try to emphasize is a zero tolerance for people call it the no asshole rule.
The biggest mistakes that I've done, at least it was probably during the first 6 months of starting the company, where I optimized when hiring people. I optimized for skills and didn't pay attention to culture. I'm talking about like the first 10 people. Like I was so eager to start building the company that I was just hiring super fast And, we had like incredible engineers that joined us, but they were not necessarily the right material to create Melio's culture. And I think one thing that I didn't realize in the beginning, and luckily we fixed it pretty fast, but the core group of people that you hire, I don't know what's the number. There are many types of benchmarks, 10, 15, 100. Their personalities become the company's personality. Like you can define company values and hang them on the wall. I think it matters, but it doesn't matter much. I think what matters is who are included in the group, in the first initial group, because their behaviors will be contagious, and other people that will join after would behave like this core group. That's how a company culture is created. You have a core group of people, and their personalities become the company's personality. Now, I wasn't paying too much attention. Like, I didn't hire like terrible people or something like that. There were good people, but I was hoping for a culture with a specific set of behaviors that I know 2 people, 3 people in the beginning were not fully aligned with, and so we had to fix this. And luckily, we fixed it very fast. But it was like an extreme fix. So now Melio is so disciplined and strict about hiring in a way that is aligned with our culture, that that mistake basically led to an extreme correction that I think is part of our identity today.
I can tell you that we were very poor hirers when we started. And it's largely because I didn't come from the industry. I didn't understand tech that well. Like, so a lot of my, if you ask me, mistakes were on hiring. And I keep telling early stage founders who I spend time mentoring and talking to is that hire people where urgency is top priority for them. If urgency isn't top priority for them, it is not going to work out. It's not about age, experience, skill set, nothing like that. But like startups who are not urgent will die a very quick death.
We made 1,000 mistakes in our previous company. We made 1,000 mistakes at Unit, but we hope we made a different set of mistakes, less costly mistakes. There are many things I would change, obviously. I can get more specific. I think that some of the hiring you're doing along the way needs to be better calibrated. I think that standing up people and talent functions is a necessity. We were too late to do it. I think having an in-office culture is important, and we're just about to get into a new office in New York, but we accepted a hybrid situation that was mixed for a long time, and we should have called it quits earlier. And we made a lot of business decisions. I mean, sales processes or positioning or product decisions that did not pan out. I think the goal is not to eliminate mistakes in building a company. The goal is to make the mistakes less costly, right? And make them, and that's the topic of atomic projects and atomic solutions, or problems and solutions. If you make all of your problems atomic, then when you fail, when a solution does not really solve a problem, at least you haven't invested much.
I believe that companies don't force people or try to convince people to join, and candidates don't persuade companies to hire them. It's both parties trying to figure out, is there alignment for us to go do something incredible together? And so that alignment for us really falls in 3 dimensions. We have alignment around values, we have alignment around motivations, and we have alignment around skill set. I definitely think values are a byproduct of kind of the way one lives, works, who they've spent time with, what they believe in. But really, very importantly here, there isn't right, wrong values. I don't think if someone doesn't share Gusto values, they're a bad person. It just means they would be more successful in a different company. And I also don't believe people have separate personal, professional values. You just have your values.
Next, Renaud Lepage, CEO of Upgrade, underscores the need for recurring revenue, cautioning against over-relying on one-time revenue products. David Haber, general partner at Andreessen Horowitz, and Jason Gus, CEO of Octane, focus on customer acquisition challenges and how you should think about product strategy across tech, credit, and capital markets. And Stephanie Kirkpatrick, CEO of Aurum, zooms in on operational efficiency and reducing the time to value.
10 years of running Lending Club, was one of the first fintech, one of the first successful consumer fintech companies. So you can imagine like lots of lessons learned. I mean, just to sort of take a few, a couple, I'd say. Maybe one in terms of like product strategy and one in terms of company building overall. So product strategy, I think what we learned at Lending Club was really the impact of recurring revenue, right? I mean, we started with a sort of product that's great for consumers. So personal loan that helps consumers sort of refinance their credit card and save on the cost of interest. So it's a really good product for consumers, but it's a product that generates a one-time revenue for the company, and it's not a frequent use product, right? You're not gonna refinance your credit cards every day or every month. It's a product you might use once every couple of years. So that creates a stream of revenue for a company that's really not as predictable as you'd like it to be. Because it's like, again, one-time revenue upfront. And so every quarter you need to go like earn new revenue, acquire new customers. And so when we took Lending Club public, that was really one of the key sort of short thesis was, hey, this company needs to go earn revenue every quarter. So at some point there's going to be a bad quarter. So I think that's obviously something we learned from and did differently at Upgrade.
In retrospect to your question, the wedge product that we started with was probably the wrong one. We started with term loans, which had a 1 to 3 year duration, that ranged from $10,000 in size all the way up to $1 million. So we had people borrowing on average about $150,000, primarily again for growth financing, really to, open up a new location or buy an important piece of equipment or, hire employees or refinance maybe, expensive credit card debt or merchant cash advance. That product had great unit economics, but had a very kind of limited, it was a very infrequent and very considered transaction. And so what happened was, and that ultimately the biggest challenge and the thing we didn't do particularly well, in my opinion, was find cost-effective ways to scale, customer acquisition and really find people. We didn't have a unique advantage in finding people at that transactional point of intent, right? You think small businesses, and it is a very large population, but getting in front of that small business owner at the specific point in time when they need a $150,000 loan to open that new location, and with a relatively, our prices were pretty upmarket, fairly low interest rates, which meant that the sort of credit box was fairly narrow. And so the funnel really narrows to a very specific point in time, both that somebody meets your credit, criteria and needs that is ready to borrow $150,000 in that moment to open that new location. And so the cost of acquiring and getting in front of the customer at that specific point in time was very challenging. And so I think a lot of the lessons of the last 5+ years in fintech were, and a lot of the successes we've seen were people who started with a financial product, or honestly, ideally software, some sort of wedge that has mere 100% approval rate. So ideally, anybody with a credit card can become your customer. If it's not software, it's a financial product like a checking account or a debit card or even a credit card where, the vast majority of people who apply, you can approve. And then you build this sort of much larger user base, understanding their kind of financial history, their financial profile, and then layer in higher LTV products over time, understanding both the transactional intent and their approvability. It really informs kind of how I think about investing today, which is bias primarily towards fintech companies that lead with software, what I would call like a network, as opposed to leading with a financial product.
We are not as concerned with speed of sales process and sales cycle because what we are concerned with is certainty, that it's roughly this long and we can expect it to be within kind of a standard cycle. What we're more interested in is after the sales cycle, right? After the signature, what I call time to value. How quickly can you get them to do their first transaction? And the more that it used to be hundreds of days, even though our API integration is easy, there were many things that we didn't know that they'd have to build. We had no playbook, right? And as we've operationalized that internally and externally, that benchmark has fallen to, on average, about 50 days. So now we can predictably say, if you sign on August 1st, you'll probably be live in less than 60 days. And then we can better forecast when will revenue hit.
We've always had to sing for our dinner. We never got fundraising easily. And so our KPIs always need to be way better and super compelling in order for us to get every drop of capital into our business, because we weren't in one of these marquee markets where everyone's like, well, all you need is an idea and a paper and a good team will give you a ton of capital. That was never our story. And so the unit economics always had to work. There always had to be tons of margin. And so because of that, one of the mistakes I believe some fintechs made, now I think very few of them make this mistake, is in the early days, you'd have phenomenal technology, sometimes phenomenal credit, and then almost capital markets was an afterthought. But we got the joke early. We understood that the difference between good capital markets execution and bad capital markets execution could sometimes, depending on your asset class, be more impactful than having the best underwriting versus the worst underwriting. Now, of course, you need to have the two play together. Without terrific credit, you can't have good capital markets. And so we kind of always invested equally into those three elements: technology, credit, and capital markets from an early on. And that really helped us support our unit economics. And so relative to many of our fintech peers, we securitized earlier. We got rated AAA from S&P and Kroll. Very few fintechs ever achieve those milestones. But what they give you is they give you access to much more stable capital markets. So you're able to access markets in far more environments, and then also far cheaper capital.
You cannot ever scale up. Like I think 2 years later, as we were going through this management change within our team, I think we kind of got together and said, what are we good at? Right? Let's forget about what the companies are using us for. What are we good at? And we spent a lot of time. And now what we've done is we've basically really granularized it to a large extent. Right? We focus on 3 different industries: banks and fintechs, travel, and digital platforms. And within those, we power 7 use cases. And that's all what we do. Right? So what we want to be is category leader in these 7 use cases versus going and saying that, oh, I can do 20 different things, etc. And this shift over the last 2 years has led us incredible success because we finally found focus, which is very important as you get late stage.
In the experience of connecting your bank account with Plaid, there are a few pains. One of them, which we call the consent pain. The consent pain explains what's going on and it tries, without having things buried in terms of service, to be really clear with the user about what's happening. And then we have other screens where you log into the bank account and verify your phone number and your identity and all those things. And so we had done mocks of kind of futuristic versions of these experiences that we could do. And obviously the futuristic versions are very streamlined. So there are fewer steps and all those things. And so we did qualitative research with people about them, and we showed them the one that we thought would be the best, which is almost like you just connect your account with just one click, like super magical. And the qualitative feedback from people, once the experience got too easy, is that it was scary. And the feedback was like, this is my finances, and I expect there to be friction, and I expect it to feel like it has weight. And if you make the UX, instantaneous, like scans your face, connect your bank account, click once, it's jarring for people because it's so important. Like the thing they're trying to do, applying for a loan or like moving $10,000 from one account, it's so important that they expect it to be a little bit difficult. And they need that friction to feel like the weight represents the activity, the action that they're trying to do. And I just thought that was really fascinating for us, which is like, you realize you're not just optimizing for conversion, you're optimizing for feel. Like the feel of the thing has to represent the kind of action that people do.
Next, Eric Gleiman, CEO of Ramp, and Greg Krasnov, CEO of Tonic, talk about evolving from a hands-on founder to a strategic leader, highlighting the need for self-awareness, quality hiring, and smart resource allocation. Christo Borisov, CEO of Payhawk, focuses on the importance of customer feedback, and Ben Miller, CEO of Fundrise, discusses the difficulties of preserving company culture amid rapid growth.
Two things that I would encourage people to think about are one, a company is an allocation of resources. If you have product market fit, probably the scarcest resource or the highest impact resource is the quality of people, and spend a lot of time on that. The second is really know what are you really good at, and what are you not, and be real about it, and that's great. I remember, I was doing a sort of a different kind of analysis, and I realized it's like, I'm only when we started Ramp, I was 33% of the headcount. I'm 10% now, and I'm soon going to be 5, and I'm soon to be 1 today. I'm about 0.5%. I'm not as useful as I used to be. I don't have as much impact in the same way. And I think at one point, I think the first blush might be like, wow, that's in some ways could feel a little scary. In other ways, it's wait a minute, this is this is incredible, but I should really be putting a lot of thought into who and how we hire, because that can unlock a ton of leverage for the company. If I'm only a small part of it, maybe I should be spending a lot of time thinking about hiring. And so I think I've spent a lot more time, probably this time around, spend closer to a third, 40% of my time just on hiring and thinking through a process and meeting with candidates. And those people are really surprised the amount of time I'll spend with them. And it's because I'm going to count on them to make great decisions. And so we spend a lot of time. It's the second time one of our first 10 hires was in talent. The other 8 were in engineering, and the last one was me. And so we made a very different set of investment choices, and where we spent time is, I think, the first big change. And the second is, I also have gotten to know more of my gaps. There's certain areas where I'm really good at it. Surprisingly, some people who know and email me is I'm a little bit disorganized. So I don't get back to people, probably, which I still feel bad about. But my sort of natural approach to things, if there's 100 things to do, I'll probably do the try to figure out what are the top 10 highest leverage, most important to the best of my ability, and the other 90 I might drop. And so I try to find for balance of who has great spikes in hyper organization and for different parts of the company. I think it's been really good.
I think one of the biggest mistakes that we have made in the company were in places where we didn't listen enough to the customer. We had many opportunities where the customers were telling what's important, and we were, understanding that feedback, but then we were trying to do too many things at the same time. And as we mature as a scale up, now the voice of the customer is a lot more clear, and we are a lot more focused on just execution and drive. We have set on the strategy right now. It's about focus and operational excellence. So these are some of the big switch we had to do. We had too many priorities, too many things we wanted to do at the same time. And when you're trying too many things to do at the same time, that's not going to be the great outcome. And now we're trying to be a lot more step by step. That at the end of the day, we have been able to achieve a lot of things, but I think that could have been a bigger toll on the team, a lot more pressure, a lot more stress on the team, and that would have been easier on the team if we had been a little bit more structured at the beginning. I'd say that's one. Second thing is, not letting people go immediately when you see things don't work. Sometimes, and there is something that I learned through the hard time, is that this is very close to selling. So I do a lot of selling. So in selling, there is a saying that, the moment you think about reducing the canvas size of the sales is the moment you should start doing it right now. Because if you wait, then it's going to be too late in about 30 minutes from now. And the same thing is with letting go of people. Unfortunately, the moment you start thinking about that somebody needs to be let go is the moment you should do it. And unfortunately, this is the worst part of the job. But at the end of the day, we try to give and support everybody in the business. For me, as a leader, when we let go of somebody, that's also part of my mistake, right?
I have a learning from my first startup a long time ago, which is that the winner is the one who sees the brutal reality as fast as possible. And, this is now, I went through a startup from 1999 to 2001. So it dates me. And then 2001, obviously, tech bubble blew up. And I watched kind of like the full cycle from 1999 was crazy. And then everything collapsed from 2001 to 2004. And so it's a funny psychological bias to not want to do the ugly, hard stuff. We went from 100 people to 300 people in 24 months, and then we went to remote. And the remote and the tripling of people, that really undermined or diluted our culture. And we're still working on that, basically. So I think that remote and really fast rates of expansion, like if you can have a certain amount of hiring and maintain culture, but if you are 100 people and you go to 1,000 people, 90% of people don't have that culture. And so I think that like having things true of the culture persists, but it's actually like the growth fights cultural norms.
In my private equity days, I've actually seen, entrepreneurs that can't make that transition from like being a really small startup guy to being a manager of an organization with over 100 FTEs. Because it's just a different mindset. You really need to then focus on, different leadership competencies. And the number one of those competencies is making sure you know what your weaknesses are. You build a team that is better than you are at whatever it is that they do. And then you become the guy that runs the orchestra as opposed to the guy that solos, right? So you no longer should be soloing. What you should be doing is really effectively making sure the orchestra all plays together to the same kind of, energy, to the same, time beat. There are all these elements you coordinate as a leader. So that's something that a lot of entrepreneurs, when you think that you're going to be the guy on top there and like telling everybody what to do, if that's your mentality, then maybe you're better off like at some point just like stepping back and letting somebody step in that can be more inclusive in the decision pattern and make sure that there is smart people coming into the team.
Finally, Trisha Kothari, CEO of Unit 21, and Soups Ranjan, CEO of Sardine, talk about the value of early founder-led sales. And Jane Alexander, CMO of Carta, focuses on the need to align goals between revenue and sales to enhance business performance.
I think there are a few mistakes that people make often. The first is that they try to hire the super experienced VP of sales at a very early stage. And what you need in the very early stage is someone who is kind of ridiculously optimistic, is going to just make it happen and get you from maybe a couple customers or in the range of 10 customers or so to the next level. And then once you have that, then you can hire more experienced salespeople and build out a sales function. That is something that I think very strongly that people often mess up very quickly.
One of the biggest lessons in the early days was we have three co-founders, right? So myself, Adi, and Zahid, we all met at Revolut. We, in the early days, decided that, in order to do sales, we'll hire someone to do sales for us. That quite didn't work out. And then we realized that we have to actually step into selling ourselves, right? And we took the company from 0 to 1 million in ARR without a sales leader, right? With just, all three of us jumping in sales calls and just, actually hand-holding the customer. The reason it's very important, if you're building an enterprise business, the reason it's very important to go from 0 to 1 million ARR without hiring a sales leader is that you will get direct feedback from the customer. Because oftentimes we make up in our minds, this is how the product should look like. But when you talk to the customer, you realize that their needs are very different. So that's one reason, direct feedback from the customer. And then the second reason is sales enablement in those early days is not really a thing. You have to actually think on your feet. And as founders, you have to be able to answer the questions of the customer on your feet, right? And only then can you actually bring in a sales leader. And that's what we did at Sardine. We hired someone phenomenal who has now taken us from one to another order of magnitude.
I think where a lot of sales and marketing teams can get into trouble is when their goals conflict. So when marketing teams are measured on pipeline and sales teams are measured on revenue, there's a gap between them, and it leads to this finger pointing of, well, your pipeline wasn't good enough, or no, you weren't good enough at closing it. It was great, and it creates that friction because the goals are different. So the first thing when I took this role, as I said, listen, my goal has to be the same goal as our CROs. We are one trying to drive revenue for the business, and we may have different aspects of that we control. Our CRO Jeff has much more control over the close rate than I do. I can help with PMM, with collateral, and things of that nature. And I have more control over top of funnel, given the nature of our business and the dynamics of our business. But at the end of the day, we are both responsible for hitting our revenue number. And that's the number that I hold myself accountable to and report to the board on.
Well, my friends, that's all for now. Thanks for tuning in. I hope you enjoyed this awesome special episode on company building lessons. And if you're part of a team that's building business, I hope you find it useful. If you did, please share it with other builders. Also, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. If you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza.